Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. Get ready because today we're looking at a departure that might just tell us more about the company's future than its current earnings. And hey, if you like getting these insider views without the jargon, make sure you're subscribed. And join our Discord community linked in the description below to keep the conversation going. So, we've got a Form 8K filing from Babcock and Wilcox Enterprises Incorporated. This isn't a quarterly earnings report, but it is still packed with important news. Think of it as a special bulletin dropping some significant announcements. The main event here is a leadership change, specifically an executive parting ways with the company. It might seem like just another person leaving, but the details of their exit can reveal a lot about the company's financial health and its plans for the future. The report is dated the 8th of January 2026, and it centers around an event that happened on that same day. This is the official notification to the public and the market about what's going down. The company in question is Babcock and Wilcox Enterprises Incorporated, often just called BWC. You might know them from their work in energy and environmental solutions. This filing is a requirement under US securities law, meaning they have to tell us what is happening when significant events occur. It's all about transparency for investors. Now, let's quickly touch on what they have listed on the stock exchange. They have their common stock, a special type of preferred stock labeled BWPRA, and something called senior notes due in 2026, which is BWNB. These are the financial instruments that the market watches closely. This section, item 5.02, is where the meat of the news is. It's all about people, specifically people leaving or joining. In this case, it's a significant departure. So John Dizuiz, who was the top lawyer and corporate secretary, is calling it quits after an impressive 30 years with the company. That is a long time to be with one organization. And his departure isn't just a simple retirement. They've entered into what is called a separation agreement. This is basically a formal contract outlining the terms of his exit. It usually involves a mutual agreement that the company won't be sued by the employee, and the employee will receive certain benefits. His actual last day isn't immediately. It is set for May 31st of 2026. This gives him about 5 months to wrap things up and transition his duties. This might suggest a planned, amicable exit rather than an abrupt firing. Here is where it gets financially interesting. If Mr. Dizuiz signs the agreement, he is set to receive $500,000 in severance pay. This isn't a lump sum. It will be paid out over a year after his last day. This extended payment schedule can be a way for the company to spread out the cost and perhaps ensure continued cooperation during the transition. On top of the cash, He's also getting accelerated vesting. This means he'll get ownership of stock options or restricted stock units, and possibly cash bonuses sooner than originally planned. Companies do this to reward long-term service and to make the exit package more attractive. It's a significant perk, especially for someone with 30 years under their belt. He'll also receive outplacement services. This is essentially career counseling and job finding assistance if he decides to look elsewhere. It's a common perk in executive severance packages, indicating the company wants to help him land smoothly in his next role. The company will also help with health insurance costs for 3 months. This is known as COBRA continuation coverage. It's a pretty standard benefit in these kinds of agreements, helping employees maintain their health coverage during the transition period. Finally, he'll still get any bonuses or incentive pay that he earned for his work in 2025. This is important to note because it shows the company is honoring performance-based compensation that was already accrued. And as part of the deal, Mr. Dizuiz is giving up his right to sue the company for anything related to his employment. This is standard practice to avoid future legal battles. Here is a twist. Even after he officially leaves as an employee, Mr. Dizuiz will stick around as a consultant until the end of 2026, earning $20,000 a month for his advice and support. This is a pretty substantial consulting fee, and it suggests his knowledge is highly valued. It also means the company is willing to pay a premium to ensure a smooth handover of his responsibilities. This consulting gig could be worth around $240,000 for the period, on top of his severance. So, what does this all mean? On the surface, it looks like a well-managed exit for a long-term executive. The $500,000 severance, combined with accelerated vesting and a generous consulting fee, indicates the company is making a significant investment to ensure a smooth transition and maintain goodwill. The filing is signed by Cameron Freimeyer, who is the Executive Vice President and Chief Financial Officer. This confirms the financial implications of the agreement have been reviewed and approved at the highest levels. Now, let's put on our investor hat. A departure like this, especially for a high ranking officer who has been with the company for decades, can signal a few things. It could mean the company is simply moving in a new direction and Mr. Daizuis is ready for a change of pace. However, it could also hint at internal reorganizations or strategic shifts where his specific role might be changing or becoming redundant. The fact that they are paying him handsomely to consult suggests they believe his institutional knowledge is critical during this transition period. This implies there might be ongoing projects or upcoming challenges where his experience is invaluable from a financial perspective. $500,000 in severance plus accelerated equity and a consulting fee isn't pocket change. It is a substantial expense that will impact the company's immediate profitability. However, if this move is part of a larger strategy to modernize or streamline operations, the long-term benefits might outweigh these short-term costs. What are the risks here? Well, losing a general counsel with 30 years of experience could create a knowledge gap, at least temporarily. The company needs to ensure his replacement, or the existing team, can effectively fill those shoes. The consulting agreement helps mitigate this, but it's still a transition period where things can be less efficient. Are there opportunities? Absolutely. This could be an opportunity for fresh perspectives within the legal and corporate governance functions. A new leader might bring innovative approaches or more efficient compliance methods. In conclusion, this Form 8K filing reveals a deliberate and financially significant exit for a long-serving executive. Babcock Wilcox Enterprises Incorporated appears to be prioritizing a smooth handover and retaining crucial institutional knowledge through a consulting agreement. While the severance package is substantial, it seems to be a strategic investment in stability during a period of transition. The company is showing it is willing to pay for expertise to navigate future challenges. What's your take on this executive departure and the company's handling of it? Do you think this is a sign of strength or a potential warning? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate analyses. And don't forget to join our Discord community. The link is in the description for even more discussions. Thanks for watching, and we'll see you in the next Decode.